Welcome back, investors. In this video, we're going to be ranking companies. I have a list of the 22 most popular stocks across social media, the ones that we've been looking at almost every day. I own many of these stocks, not all of them, but many of them. And we're going to be ranking them based on their free cash flow. Free cash flow is the thing that you want from any company you invest in. It's the whole basis of the investment. It's the money you get from making that investment. And in this case, we're going to be factoring in three parts of the free cash flow: how fast it's growing, how predictable it is in the future, and the current valuation or the current yield of that cash flow. The higher yield means the lower value the stock is, the cheaper it is. So we have the tier list here. Let's go ahead and get started. We're going to start off with Google. Let's go ahead and take a look at the cash flow. Now, to look at the cash flows, we're going to bring it up in Qualtrim. If you haven't tried this out, you can try it out for free. It's part of the software included in my Patreon. But if we look at Qualtrim and we look at the quarterly TTM, that is the trailing 12 months of all these different metrics. And I think that this by far gives you the best look at the free cash flow of a company, because cash flow quarter by quarter can be really sporadic. For example, if we look at this, it's kind of all over the place, right? There's some jagged ups and jagged downs. It's hard to kind of see any trend in this. But when we switch over to TTM right here, it adds up all the most recent quarters and we get a much better look at how things are trending. In this case, we see that Google's cash flows are rising over time, but they've also gone down a little bit over the past 2 years. In 2021, they were making $70 billion. Now they're down to $55 billion. The reason why the cash flows are going down while the earnings are going up is because Google is making huge CapEx investments that they're amortizing for their servers. They have all these AI tools they're coming out with. They need a lot of processing power. They're investing a ton into their artificial intelligence servers. So the cash flows are actually somewhat flat right now for the past couple of years. Over a 10-year period, they've grown quite fast. And then one other thing I'll be looking at for each of these companies is the free cash flow compared to the stock-based comp. Google makes a fortune of cash, but they also have a large amount of stock-based comp, which is dilution. If you make a lot of money, but then you dilute the shareholder, that eats into the cash flow the shareholder owns. So in this case, Google over the past 12 months has generated $55 billion of cash flow. That's a lot of money, but they also spent $22 billion in stock-based comp. So between the two, if you net that out, that is a net $33 billion of free cash flow. Not bad. The starting yield is around 1.5%, depending on whether or not you're factoring in the stock-based comp. Last year, I put Google as an A. Right now, I'm putting it as a B. And the reason why is because they haven't grown free cash flow in 2 years. So they're getting a bit of a demerit for that. We're factoring in that their cash flows have gone down because of these huge CapEx investments. Overall, Google's in pretty good shape. They're growing their free cash flow over a multi-year basis. It's rather predictable in my opinion. And the valuation isn't too bad right now. So this one I think is in a nice place in B. Next up, we have one of my largest holdings, S&P Global. This one's really easy. It's going to go in the S tier category. There's not many companies on planet Earth that have as predictable, fast growing, and valuation that S&P Global has. When we look at S&P Global and the cash flows over a long period of time, they have re-accelerated at a very fast pace. Look at that free cash flow growth. $5.14 billion over the past trailing 12 months. Even on a free cash flow per share basis, because they did do a major acquisition, it's still growing incredibly fast to all-time highs. We also have very little stock-based comp. So we know that Google is paying like $20 billion in stock-based comp. This company, out of the $5 billion in free cash flow, only spends $200 million in stock-based comp. So they don't have many expensive employees diluting the shareholder. So this is very pure free cash flow. Another thing I'll mention is this company continually raises the guidance. They've done it over and over. They raised it from 4.3 billion to 4.7 to 5.3. They continually keep saying we're going to earn even more than we previously expected. And I love companies that continually earn more and more money than they say they're going to investors. When we look at the valuation, it's also very undemanding. It trades at a 3.1% free cash flow yield. So even the yield of the company is good compared to the market. S&P Global is firmly in the S tier. It's hard to compete with that. Next up, we have Amazon, which a lot has changed over the past year. If you remember the video a year ago, I put Amazon way down in the E tier towards the bottom because Amazon's cash flows looked terrible at the time. But here we are in 2024 and a lot has changed. As I predicted at the beginning of the year, Amazon would have a huge influx of free cash flow. That's because they exercised operating leverage, they cut back on CapEx, they have a lot of growth in their business, and they're able to swing their cash flows from one end of the spectrum to the other. Now when we look at Amazon, it has gone from deep in the red territory, way down in 2021, early 2023, they had minus $30 billion of free cash flow. So that's near the F territory. That's terrible. They're losing enormous amounts of money. But we look at the future with this company, And they've swung that from minus $30 billion to now all the way up to $43 billion in free cash flow. And it's going up at an incredible pace. That is a growth rate of 153% year over year. Amazon does a lot of stock-based comp, but they're also getting the stock-based comp under control. It continues to go down every single quarter in aggregate. So they're cutting expenses while growing the free cash flows, and the free cash flow per share is almost at all-time highs. The company has a low starting yield right now, but that's without their Q4 factored in, which is typically a huge quarter for Amazon. So it's likely going to be a lot higher if we factor in this last quarter. Right now, Amazon is at an A, just above Google here. The company's very predictable. They have all these service businesses with advertisement, third-party sellers, AWS. They're in so many different things doing really well, and the cash flows are going to grow substantially in the future. Now, next up, we have Intel, which is obviously in the F category. I believe last year I had it in the E category. It was already really bad, and things have only gotten worse for Intel. This company is an unmitigated disaster. It's the story of a turnaround play that never turned around. Now the CEO's out, so they're trying to change leadership, seeing if they can salvage the situation, but it looks so bad. The stock is down 56% this year. For the past 10 quarters on a trailing basis, they have negative free cash flow. In most cases, it's minus $10 to $15 billion. So this company is lighting money on fire. On top of that, Intel's cash flows aren't predictable, and the valuation also isn't really low because they're not earning any money. So it's difficult to value a company that is completely unprofitable. Intel investors are simply hoping for something magical to happen. Next up, we have Booking Holdings. This is one in my portfolio, and I'm rating this one as an S. And I'll go over the reasons why I think this one belongs in this category. When we look at Booking Holdings, the company seems like a riskier one, less predictable, but it's turned out that vacationing is rather predictable. Going on and having experiences, seeing something different, seems to be one of the most predictable things of all human life. Once people can afford a house and a couple of cars, they spend all their excess money on experiences and primarily vacations. When we look at the history of it, it also shows a very stable cash flow company that grows at a very rapid rate. All the way back since around 2007, look at this quarter by quarter. The only time where it really struggled was a one-time outlier event, which was COVID. Obviously, that's going to cause some issues with a vacation company. But outside of that incredibly unique, unlikely to occur ever again in our lifetime occurrence, it seems like the cash flows are rather dependable and predictable. The free cash flow is also very efficient. They have almost no stock-based compensation, and they generated $8.5 billion in cash flow in the trailing 12 months. The free cash flow per share is growing at a rate of around 20% per year. That's faster than most quality compounder companies that you can find. The business reinvests all of that extra cash flow into dividends and primarily buybacks, and they do so rather efficiently. And while they're generating all this growth in free cash flow, they also start at a hefty yield of 4.5% to 5% free cash flow yield. What is there to nitpick with Booking Holding? What else could they possibly be doing? It's one of the best free cash flow companies in the market that exists. Next up, we have a stock that's becoming more popular across social media, which is Uber. This is one that I've done a decent amount of analysis on. I'm going to throw this one in the A category where I believe it belongs. When I look at Uber in these three different categories, Uber's fast growing. Uber has a high free cash flow yield to start with, which means it has a low valuation. The predictability is the only thing that I think is still in question for Uber. So let's take a look at the numbers of this one for just a second. We look at Uber and the free cash flow growth. It shows an incredibly consistent growth pattern over the past couple of years. For example, in 2020, it was way in the red. Then it went to neutral. The CEO said we need to grow and become a profitable company, and they did it. It continues to grow. Now, of course, they have the challenges of a company that pays a lot of stock-based comp, so some of that free cash flow is being eaten up. Overall, this trend looks really good. Free cash flow is growing rapidly for this company. The valuation before factoring in stock-based comp is 4.75%, which is really juicy. After factoring in stock-based comp, it's still 3.3%. That's still a great valuation for this company. So overall, it looks like it's in great shape, and Uber is one of the companies that really turned itself around. Again, a couple of years ago, it really looked like a weak, money-losing company with a questionable business model. Now it really showed its network effects and its operating leverage. The question that still remains for Uber is the question of long-term predictability. Robotaxi is a real thing. Full self-driving is real technology. I believe that in the future, there's not going to be people riding cabs with drivers. Uber's not creating their own full self-driving technology. They don't have their own robotaxi technology. They are completely reliant on making deals with other people. And anytime a company has their fate in someone else's hands, that creates a more questionable situation. So I can't say with 100% certainty what the future looks like for Uber. For me, I think it's most likely going to be good, but it's not quite as predictable as other companies that have their fate more in their hands. Next one we have is Tesla. This is going to make a couple people upset, but before you get out your pitchforks and torches, let me say a couple things to explain why Tesla's going in the C category. Remember that I'm basing this on predictability, growth of free cash flow, and overall the valuation currently. When we look at Tesla, the growth of the free cash flow has been negative over the past couple of years. So it's gone down from 2022. Obviously, that is not the ideal situation. The stock has been relatively flat since around 2021. It's finally going through a big surge in sentiment and price increase. But when we look at the free cash flow, this is still a downward trend. But Tesla today, over the trailing 12 months, generated $3.6 billion in free cash flow. That's super low. That's less than what Uber generated. Now, obviously, investors are hoping that they can grow this free cash flow a lot with their full self-driving and other developments. If we look at Tesla next year, their expectations are around $4 to $5 billion, so right around there. That's better, but that's still not amazing for how expensive this company is. The biggest problem with Tesla right now is that the market cap is $1.5 trillion, and they're generating only $4 to $5 billion in free cash flow, making the overall cash flow yield 0.24%. And then when you factor in stock-based comp, 0.12%. So investors are paying hundreds of times the trailing 12 months free cash flow for this company, which is an incredible price to pay, meaning that Tesla just has a lot priced into the stock. All these visions of the future, the robotaxi, the full self-driving, everything needs to work out really well for this company to justify its current valuation. It can do that, but Tesla has a lot more to prove over the next couple of years than any of these other companies. Next up, we have ASML, the advanced lithography machine maker. This one is going to go right there with Google in the B category. ASML is a company that really benefited from the huge influx of demand for artificial intelligence. That caused the free cash flows to go up dramatically in 2022. Since then, their number of bookings has gone down a little bit. The free cash flows have gone down a little bit. Some of these companies like TSMC are holding back on some orders. Now, the reason that I put this one in the B category instead of the A or S is for a couple of reasons. First of all, the free cash flow is very volatile. When I see a company that has these huge spikes and then these ebbs and flows in free cash flow, that's just a bit less predictable of what you're really paying for the company. Right now, the company still doesn't look super cheap, trading at 100 times trailing free cash flows, which means that investors today buying this company need to have really good expectations of the future. It doesn't look quite as expensive as Tesla, but they still have glowing expectations of the future. With a company like ASML, they can't afford to face any meaningful competition. So even though ASML has carved out this really cool place for its business, it's a bit of a monopoly, I still put the company in the B tier. Next up, we have Costco. This is one of my larger holdings. It's been a very good performing one, but Costco's unfortunately going to go down right with Tesla into the C category. Let me explain why. Costco's a fantastic company, one of the best, but when I look at the valuation today, it's trading at a 1.3% free cash flow yield, which is rather expensive for this company. There's not many retailers that you want to pay this high of a price for. Of course, Costco is unique with that subscription membership business, so that changes the calculation a little bit. It makes the company more predictable, but the free cash flows are still growing over time. They're not perfectly consistent. But overall, the free cash flow is growing for this company. The best thing about Costco is its incredible predictability. The company is insanely predictable. They have such loyal members. It continues to grow lockstep. But it's not growing super fast. It doesn't have the potential to grow like a Tesla does with its full self-driving. The valuation isn't quite as demanding as a company like Tesla, but it's also rather high without as much growth potential. So all things considered, right now I see it as a C. Next up, we have Microsoft. This one is going in the A category. Microsoft usually belongs in the S category, but this time, since we're factoring in valuation, the valuation is going to push it down a little bit to the A category. When we look at Microsoft, the company is as good as it gets. It's growing its free cash flow at a very fast speed. The free cash flow is highly efficient. They don't have much stock-based comp. Again, it's growing 15% per year, which is very fast. The only thing that's questionable about Microsoft is the 1% free cash flow yield. You're paying a lot of money to buy this stock right here. That's why it's in the A category, not the S category. Now, next we have Netflix. This is a company that was previously in the B category. Now I'm upgrading it all the way to the S category. Netflix has S tier free cash flow, and I think that's easy to argue right now. When we bring up Netflix and look at the pure data here, we can see how good this company's cash flows are. It went from in the red and flat up to around $7 billion in trailing free cash flows. So they're earning $7 billion. They've been able to keep that. And in fact, they're projecting growth over the coming years. This cash flow is also highly efficient. They do far less in stock-based comp than major big tech companies, many other companies in the market. So while they have $7 billion in free cash flow, they're only paying a couple $100 million in stock-based comp. The free cash flow per share grows incredibly fast as they're efficiently funneling this money into buybacks. And while all that's going on, Netflix still trades at a reasonable valuation, a 2.3% free cash flow yield, where other companies, again, like Microsoft, are at 1.5% or 1%. So Netflix is also not insanely expensive at this price. Netflix has been one of my most profitable investments, and it's been incredible to see this company climb the ranks of having really poor quality cash flows to now being in the S tier. Now, next we have Salesforce. This is another company that I invested into in 2024. This one is now in the A category. Salesforce has really proven its ability to raise its operating margins, increasing its cash flows dramatically in a short amount of time. When we look at this one, Salesforce has this gradually growing top line that seems like it's ever growing in all these different categories, but they also have a margin expansion story. When you combine the two of them, you get cash flows that look like this. Look at the free cash flow. This is on a quarterly trailing basis. That's incredibly fast. That's 34% year over year. Now, some of you will argue that Salesforce pays a lot in stock-based comps, so there's a lot of dilution. But even looking at that, the stock-based comp has been flat since 2022, and the free cash flow has around tripled. So the free cash flow is growing dramatically while they're keeping expenses flat. That is what this company's doing, and you have to give credit to management here. They've really made this company profitable. When I look at the companies that I cover, Salesforce is one of the fastest free cash flow per share growth companies, growing at 36% last year. Over the trailing 2 years, they've grown it at 47%. The valuation is higher now because the stock is getting a good bid, but it's still at a 1.7% free cash flow yield. It's not extremely expensive and it's not cheap. So I believe this one belongs in the A tier category. If they can continue their margin expansion, keep costs under control, and they get to a decent valuation, this one will move up to the S tier. Next up, we have Nvidia, and this one is likewise going to go into the A tier. What's preventing Nvidia from being in the S tier? A couple things. Primarily that we don't really know how predictable this company actually is. When I look at the free cash flows, for example, they've gone up so much in the past year. This is not just normal cyclicality. This is exponential, incredible, one-time growth, and it's an abnormality. Anytime we see a company 10x its free cash flow in a single year at the scale that Nvidia did, it raises questions of how sustainable this growth is. What does the future look like? Are they going to give back any of these gains, or will they continue to keep growing? We just don't know. The lack of predictability is one problem. The other issue is the current valuation. Even with their incredible increase in free cash flow, Nvidia is expensive today. It's really expensive on a free cash flow basis, with a yield of only 0.32%. So even though Nvidia has had this humongous growth over the past year, investors are still pricing in a lot of future growth. So I give a lot of respect to what Nvidia has accomplished, but the reason I don't put this one in the S tier category is the valuation and the questionable predictability. Next up, we're going to be looking at two companies at once because they're so similar, Visa and MasterCard. I own MasterCard, I don't own Visa. They're both going in the A category. Both of these companies look very similar, so I won't go over both the financials, but I'll just say that they both have fast-growing free cash flows. It grows at a steady rate almost every single year. There's some slight volatility, but overall, you get the picture. MasterCard is at a higher valuation, but growing a little bit faster. Visa's at a lower valuation, growing a little bit slower. All else equal, I rate them about the same. The reason that I put both of these companies in the A tier instead of the S tier is because the valuation is no longer super juicy for these companies. If you buy them today, you're paying at the high end of the scale. Now, next up, we have Palantir. And I'll go ahead and just apologize in advance for Palantir investors. I have to be honest here. I have to show you what I'm honestly thinking. When I look at Palantir right now, if we were just focusing on the free cash flows and ignoring valuation, we weren't looking at valuation at all, then it would look pretty good. But when we factor in the valuation with the yield of the company, that's where Palantir really gets knocked down. Right now, I still see this company at an E. Let's go ahead and take a look why. When we look at Palantir The company's doing fantastic fundamentally speaking. They are growing their free cash flow. We look at this and I see a trend line that looks really good. It went from the negative in 2019 into the positive in 2022, and then they started earning good amounts of growth in 2023 and 2024. Now up to $1 billion in free cash flow on a trailing basis. The growth of Palantir will continue. They're coming out with new products. They're closing a lot of contracts. They have a product that's really impressive. So I like everything that's fundamentally going on with the business. Right now, their free cash flow is mostly being eaten up by stock-based comp. So we look at the high levels of dilution relative to their free cash flow, and it's over half. So over the trailing 12 months, they generated $1 billion in free cash flow, $540 million of dilution. So the net between the two is only around $437 million. Now, to put this in perspective, this is what I like to do is when you're buying a company, you're paying for the cash flows of the company. And again, normally this would be great. It would be great to buy Palantir today based on the fundamentals. The problem is the stock went up 350% this year. So the price has gone up way more than the cash flows have grown. So we look at this company and the free cash flow yield is 0.06% on a trailing basis. When you factor in stock-based comp, which again eats away half of it, it goes from a 0.06% to a 0.03%. Salesforce has a market cap of 340, Palantir is 170. Salesforce's free cash flow they generated when you subtract out stock-based comp is $8.82 billion. Palantir's, again, when you minus out stock-based comp, is $437 million. So again, I look at this and I see that Palantir is trading at roughly half the market cap of a Salesforce, but produces 1/20th of the current free cash flow. Now, I get that it's going to grow. Salesforce is going to grow too. Palantir is going to grow. Maybe it can justify it over the very long term. But when I look at the situation right now, the expectations are insanely high for this company. Stocks can do some incredible things, so maybe Palantir can pull it off, but what I see right now is very dangerous risk and reward. Next up, we have Disney. This is a company that's actually making progress in the right direction. Last time I had it in the D category, now I'm moving it up to the C category. And hopefully over the next year or so, I'll be able to move this one up even further. In fact, their cash flows are just above where they were in 2014. So it's been around 10 years of the same cash flows from Disney. And you'd expect to see this type of property have better growth. But the main reason this one isn't even higher is because of the lack of leadership. That makes it very difficult to predict the future of this company. So right now it's in the C tier. Now next up we have a new one to the list, one of the most popular stocks today, which is MicroStrategy. And this one is going firmly in the F tier. This company really doesn't even make free cash flow. So when we're looking at the company and trying to do analysis on how good the free cash flow is, obviously we're going to have problems here when they have no free cash flow to begin with. This company simply takes out leverage, they buy crypto, they focus on buying as much of a speculative asset as they can, and hopefully more people buy it after them. That's how they've made gains before. And Michael Saylor, the leader of this company, has had a history of explosive growth in a company, followed by bubbles popping and huge destruction. The stock today is up 500% this year, with the price of Bitcoin going up above $100,000. So right now, things look really good. When you leverage up and you tie that to a somewhat speculative asset, fortunes can change quickly. Now, next up, we have Adobe. This is a great company that has many qualities I look for in companies, mostly recurring subscription revenue. It has a product with millions of users. But even so, I'm putting this one in the C category. Adobe is a mixed bag for me right now. And the big reason why is the predictability of the company. Adobe's main product is photo and video editing, which is changing so dramatically every year. And personally, I feel like they face far more competition today than they did 10 years ago. So for me, just because of that lack of predictability, that brings them down a little bit. Next up, we have FICO. This one's really simple. It's going in the S tier category. The free cash flow per share has grown 32% on a trailing basis. That's very fast. They funnel this money into buybacks, further growing that free cash flow per share. There's an argument that if FICO can truly grow their pricing power by 20+% a year, then they can justify today's price. For that reason, I put it as an S tier. Now, next up, we have a new one to the list, which is Broadcom. This is a company that I'm going to start following. Right now, I'm going to put it in the B category. And that's again because we're factoring in valuation. When I look at Broadcom, I see incredibly strong fundamentals. This company is really impressive. When we look at the free cash flow, it is a mountain of continual growth, very low amounts of volatility. Look at this free cash flow. It's almost a straight line. It's growing at roughly 16% per year. That is in the elite S tier category of growth. So the growth, the consistency is incredible. The only problem with this company is the valuation. If it was trading just at a bit lower of a valuation, I would put it as S tier. But since it's trading at a 0.57% free cash flow yield, that's quite expensive. Right now, it's just a little too expensive to put in the S tier category. Now, last but not least, we have Apple. This one I'm also going to be putting in the B tier. Apple stock continues to climb, but the free cash flow isn't quite following this year. When we look at the free cash flow from 2022 to 2024, it went from $100 billion down to 97, back up to 100. It's basically been flat for the past couple of years. The other issue with Apple today is the valuation, and this is a common occurrence. We're seeing this across many companies. There's so many companies that would be S tier if their valuation was a little bit better. But when I was first buying Apple 5 or 6 years ago, the free cash flow yield was 4%. So I was buying this nice, juicy 4% yielding Apple. Right now, it is less than 1%. So investors today are paying 4 times the price I was 5 years ago. That's a lot more expensive. When I look at Apple, it's true that it's a wonderful company. This company is fantastic, but as long as we're factoring in valuation, I can't put it as S tier. So overall, that's how the list looks today. Let me know what you think of it. If you have any disagreement, let me know in the comments below. That's all for now. See you in the next one.